Lease payments include several components that you should consider in the initial measurement of the lease liability on the commencement date of the lease. The first component of the lease payments is fixed lease payments. These are the fixed payments that are made periodically by the lessee to the lessor, and they are usually stated clearly in the contract. The second component of the lease payments is the variable lease payments. We have two categories for these payments. The first category is the variable payments that are based on an index, such as the Consumer Price Index, or based on a rate such as London Interbank Offered Rate. This category of variable payments is included in the measurement of the lease payments. The second category is the variable payments that are based on any variable other than an index or a rate, for example, payments that are based on performance, like those calculated as a percentage of sales made, or payments that are based on usage, like for example the payments calculated based on the number of hours the leased equipment is used, or the number of miles driven by a leased vehicle. This category of variable payments is not part of the lease payments. Instead, they are charged to the profit and loss in the period in which the event, or the condition that triggers those payments occurs, unless other standards require to include these payments in the carrying amount of other assets. The variable lease payments that are based on an index or a rate, are measured at the commencement date, by referring to the value of that rate or index at the commencement date. And if these rates and indices change subsequently, the future lease payments should be revised to reflect these changes. We will see an example for this in the following lecture. The third component of the lease payments is the in-substance fixed lease payments. The first component of lease payments that we talked about was the fixed lease payments, and the second component was the variable lease payments. Here, the third component, which is the in-substance fixed payments, are payments that have the form of a variable payment, but in substance, those payments are unavoidable. For example, a lessee leased a retail store with the following payment terms. If sales were less than 1,000 units, then the lease payments shall be 10,000 annually. But if sales were greater than, or equal to 1,000 units, then the lease payments shall be 100,000 annually. This is an example of in-substance fixed payments. The payment terms appear to be variable, because they vary with sales, but in substance, there is always a lease payment that is unavoidable, as the lessee would still have to pay a payment even for zero sales. So, the lease payments here are not purely variable payments. Let us see some forms of in-substance fixed payments. The first form is when the variable lease payment terms have no real economic substance. This can be the case when the payments must be made only if an asset is proven to be capable of operating during the lease, where in reality, there is no reason to believe that the asset might not operate. Also, it can be the case when the payments must be made only if an event occurs that has no realistic possibility of not occurring. Let us assume that McDonald's leased a sales outlet in a busy commercial district. The lease payment terms were as follows. 10,000 monthly, if no sales were made from the sales outlet. 100,000 monthly, if sales were made from the outlet. The payment terms here appear to contain variability, because the payments are based on sales. The lessee might pay either 10,000 or 100,000 monthly, based on the sales volume. But these terms have no real economic substance, because there is no realistic possibility that McDonald's won't achieve any sales, given its popularity and the location of its sales outlet. So, the in-substance fixed payment here is the unavoidable payment of 100,000 monthly, that should be included in the measurement of the lease payments. The second form of in-substance fixed payments is when the payments are initially structured as variable lease payments, that are linked to the use of the underlying asset, but for which the variability will be resolved at some point in the future after the commencement date, so that the payments become fixed for the remainder of the lease term. Those payments become in substance fixed payments when the variability is resolved. An example of this is, when a lessee signs an agreement to lease a vehicle for 3 years. The monthly payments during the first year are calculated as 10% of the monthly mileage made by the vehicle during the first year. The monthly payments for the remaining 2 years will be fixed at 15% of the average mileage made by the vehicle during the first year. Here is the monthly mileage driven by the vehicle during the first year, and the lease payments during the first year as 10% from the monthly mileage. These payments are variable payments that are based on a variable other than an index or a rate, and therefore, are not included in the measurement of lease payments. Instead, they are charged to the profit and loss. Starting from the second year, the payments became fixed at 15% of the average monthly mileage achieved during the first year. Here, the variability in the payments was resolved at the beginning of the second year, and therefore, these payments are the in substance fixed payments that should be included in the measurement of the lease payments. Another form of in substance fixed payments is, when there is more than one set of payments that a lessee could make, but only one of those sets of payments is realistic. In this case, an entity shall consider the realistic set of payments to be the lease payments. This form is somewhat similar to the first form of in substance fixed lease payment. If you return back to our McDonald's example, there was more than one set of payments that McDonald's can make, either to pay $10,000 monthly if no sales are made, or $100,000 monthly if sales were achieved. There is no realistic possibility that McDonald's won't achieve any sales. So, the realistic set of payment is the $100,000 monthly, and this is the in substance fixed payments that should be included in the measurement of the lease payments at the commencement date. Also, when there is more than one realistic set of payments that a lessee could make, but only one of those realistic sets of payments should be made. In this case, the lessee shall consider the set of payments that has the lowest present value to be the lease payments. For example, a lessee leases a retail store for 3 years. Payment terms are as follows. For the first year, the lessee shall pay $50,000 on a quarterly basis. For the remaining lease term, the lessee has 2 payment options to choose from. Either to continue paying $50,000 on a quarterly basis, or to pay $15,000 on a monthly basis. Here, the lessee has 2 options for payments after the first year, and both options are realistic sets of payments that the lessee can make. So the in substance fixed payment that should be included in the lease payments is the set of payments that has the lowest present value. The fourth component of the lease payments is the exercise price of a purchase option. The lease agreement might include an option for the lessee to purchase the leased asset at the end of the lease for a certain price. That exercise price is included in the measurement of the lease payments, if there was a reasonable certainty at the commencement date that the lessee will exercise the purchase option. The criteria used in that assessment are the same criteria we used in the assessment of the lease extension or termination options, that we covered in the previous section. The fifth component of the lease payments is penalties for terminating the lease. If the lessee has an option to terminate the lease agreement, and there was a penalty that the lessee should pay for lease termination, then this termination penalty should be included in the measurement of the lease payments, only when there is a reasonable certainty at the commencement date that the lessee will terminate the lease. Another component of the lease payments is payments expected to be made under residual value guarantee. In some lease contracts, the lessor may require the lessee to guarantee that the leased asset will have a certain fair value at the end of the lease term, for example $10,000. Lessors usually demand that guarantee from the lessees, to ensure that the lessees preserve and maintain the leased asset during the lease. If the actual fair value of the leased asset at the end of the lease term decreases to $8,000, then the lessee is obligated to pay the difference to the lessor, which is $2,000. So, at the commencement date, if it is expected that the fair value of the leased asset at the end of the lease term will drop below the guaranteed residual value, then the lessee should include the difference in the lease payments when assessing the lease liability at the commencement date. The seventh component of the lease payments is the payments for non-lease components. As we mentioned in previous lectures, the contract might include lease and non-lease components. Payments allocated to the non-lease components are not included in the lease payments, because they are not considered lease transactions. However, if the lessee elects to account for both the lease and non-lease components, as a single lease component under the practical expedient, then the payments allocated to the non-lease components are included in the lease payments on the commencement date. The last component of the lease payments is lease incentives. The lessor might encourage the potential lessee to sign the lease agreement by giving him some incentives, for example, an upfront cash payment to be made by the lessor to the lessee, or the assumption by the lessor of some of the costs incurred by the lessee for obtaining the lease. So, at the commencement date, the lessee should deduct these incentives when calculating the lease liability. These are the components of the lease payments. Now, let us illustrate with few examples.